What if you could ignore the noise? The flashing tickers, the frantic traders, the talking heads all yelling over each other. For the last 50 years, many of the biggest market crashes were preceded by one simple signal, and it has nothing to do with the stock market itself. It's not buried in some complex chart, and it's not a secret whispered between Wall Street insiders. In fact, you see it every day. It's the price of oil. And in the next few minutes, I'm going to show you the shockingly simple pattern that connects crude oil to economic turmoil, a pattern that has repeated for over half a century and serves as a powerful, often overlooked warning. Most of us think of recessions as these complex, unpredictable monsters that just show up out of nowhere. One day, the economy's flying high, and the next, headlines are screaming about a crash. Experts will point to a dozen different reasons: interest rates, housing bubbles, tech manias. But what if a primary trigger was much simpler? When you look at the data, a fascinating pattern emerges. A sharp, sustained spike in the price of crude oil has preceded many major US recessions since World War II. Now, it's not a perfect crystal ball. No single indicator is. There are plenty of other metrics out there, from the Buffett indicator to the Hindenburg omen that analysts use. And some downturns, like the dot-com bust in 2000 or the brief crash in 2020, had other causes. But the link between oil shocks and recessions is no quirky correlation. It can be a direct cause and effect relationship, a predictable chain reaction that starts at the gas pump and can end in serious market pain. Think about the major economic downturns: the stagflation of the 70s, the brutal recession of the early 80s, the dip in the early 90s, and yes, even the lead up to the 2008 great financial crisis. Each one has oil's fingerprints on it. The warning sign was flashing, but most people were looking in the wrong direction. The story really kicks off in the 1970s. Back then, the American economy felt unstoppable. But in 1973, that illusion shattered. In response to US foreign policy, OPEC declared an oil embargo, cutting off supply to the United States. The effect was immediate and catastrophic. The price of oil quadrupled almost overnight. Gas stations ran dry, with lines stretching for blocks. But that was just the start. The economy, which runs on oil, was gripped by stagflation, a toxic mix of a dead-in-the-water economy and soaring prices. The oil shock didn't just annoy drivers, it helped shove the nation into a deep, painful recession. Then, just as the world was catching its breath, it happened again. The Iranian Revolution in 1979 and the Iran-Iraq War that followed crippled global oil supplies. Prices surged, and the result was the same: another brutal recession in the early 1980s. When Iraq invaded Kuwait in 1990, oil prices spiked again, and like clockwork, a recession followed. The pattern was set. A sudden, sharp jump in the price of oil wasn't just a headline, it was a wrecking ball for economic growth. But why? How does the price of a single commodity manage to cause so much chaos? The reason oil is such a powerful signal is because it's more than just a commodity. It's the lifeblood of the modern world. Think of an oil price spike as a sudden, unavoidable tax on the entire global economy. This tax hits in three devastating stages. First, it hits production. Oil and its byproducts are in virtually every supply chain. It fuels the trucks, ships, and planes that move goods. It's a key ingredient in plastics, fertilizers, and building materials. When oil gets expensive, the cost of making and shipping everything goes up. This squeezes businesses everywhere, from the farmer to the factory owner. Second, it squeezes you. You feel it directly at the pump and on your utility bill. When it costs twice as much to fill your car or heat your home, that money has to come from somewhere. Usually, it comes from your disposable income, the cash you would have spent going out to dinner, buying a new phone, or taking a vacation. This drop in consumer spending is a body blow to an economy that's 70% driven by people buying things. Third, and this is often the final nail in the coffin, is how the government reacts. Faced with runaway inflation from the oil shock, central banks like the Federal Reserve have one main tool: raising interest rates. They intentionally make borrowing money more expensive to cool down the economy. So now you have a trifecta of economic poison: higher costs for businesses, less spending from consumers, and the central bank slamming the brakes. That three-punch combo is how an oil spike can help bring an economy to its knees. It's a powerful yet simple mechanism, isn't it? Understanding it gives you a lens to see what might be coming that few people have. If you're getting value from this breakdown, do me a favor and hit that subscribe button and ring the notification bell. We're all about revealing the real forces that shape our world. You might be thinking, okay, that makes sense for the 70s, but is it still relevant today? The pattern hasn't gone away. It just shows up in different ways. Let's look at the 2008 Great Recession. Everyone remembers the housing collapse and the banking crisis. But there's a crucial part of the story that's often ignored. In the year leading up to the crash, the price of oil went on a relentless parabolic run. In July 2008, just before the financial system imploded, crude oil hit its all time high of $145 a barrel. This wasn't a supply shock like in the 70s, it was driven by booming global demand, but the effect was painfully similar. It acted as that same brutal tax on the global economy, draining consumer wallets at the exact moment the housing market was wobbling. While the financial crisis was the main event, some economists argue that this crippling oil price acted as a major accomplice, making a bad situation much, much worse. Then, in 2020, we saw the inverse proof. The pandemic triggered a global shutdown. Demand for energy vanished overnight. And what happened to oil? It experienced the most dramatic price collapse in history, with one US benchmark famously trading at negative prices. A historic economic collapse caused a historic oil price collapse, proving just how deeply the two are connected. So, what is this signal telling us right now in late 2025? Of course, oil isn't the only story. We all saw the global market dip back in April 2025, which was driven more by sudden changes in US tariff policy than by the price of oil. It's a great reminder that many forces are at play. That said, for the past year, oil prices have been surprisingly moderate. After the shocks of the early 2020s, Brent crude, the global benchmark, has been hovering in the 60s. As of October 2025, prices have been trading at 4-month lows. Forecasts from major institutions like the U.S. Energy Information Administration and JP Morgan suggest this trend of stable to lower prices could continue into 2026, with some analysts seeing prices potentially falling toward the 50s. The reasons are twofold. On the supply side, non-OPEC plus countries, especially the US, are producing at record highs. On the demand side, concerns about slowing economic growth and trade tensions are keeping a lid on consumption forecasts. However, the oil market is never truly predictable. Geopolitical risks are a constant wild card. Tensions in the Middle East or disruptions from the conflict in Ukraine could change the picture in an instant. So, while the oil signal isn't flashing bright red right now, it's a dial you can never take your eyes off of. For decades, we've been told that to understand the economy, we need a PhD in stock valuations, bond yields, and central bank minutes. We're shown 1,000 complex charts, each one promising to be the key. But sometimes the real story is simpler than we're led to believe. The global economy runs on energy, and oil is its master resource. Its price is a direct measure of the pressure building up in the system. A sudden dramatic spike has been one of the most powerful and historically consistent warnings that the system is under stress. Forget the noise. If you want a clue about what might be coming for the economy, you don't always need a Wall Street terminal. Sometimes all you need is to pay attention to the price at the pump. The next time you hear people debating the next recession, you'll know about the secret signal they might be missing. If this video changed how you think about the economy, hit that like button and share it with someone who needs to see it. And don't forget to subscribe for more insights that cut through the hype. Thanks for watching.